Welcome back to this tutorial on financial modeling on Android using Kaluta projection methodology. Last time we ended up in modeling of overdrafts and accruals. Now let us proceed to model fixed assets. So I will create a sheet by clicking on the plus sign located to the bottom left corner. So I'm clicking it to create a sheet which is now named sheet 1. So I click on the sheet name to rename it, choose the rename option, and then type assets. So that is the name of the sheet. Now let me copy from working sheet, let me copy the annual and monthly rows and paste them in the assets sheet. Okay, so I select them, highlight to select them. Before I copy them, let me arrange them so that they appear presentable by aligning them to the right. So alignment here to the right, and by bolding them. So here on this option, bolds. Okay, so now I can copy by clicking on the cycle to the upper left corner of the selected area. Click on the cycle to open the local menu, and on the local menu I choose copy, then go to assets, then click on B column so that A column is for particulars, and then tap to paste. I can paste this format to other sheets also, so let me go to P&L sheet and click on January on top at tier 1 area, paste, tap to paste. Do the same on cash flow sheet, click at the beginning, tap to paste, and on the balance sheet it is hidden, so I slide to the left to bring it, click on balance sheet, the same, tap to paste. Okay, so let's go back to our asset sheet now. Now we are going to model fixed assets. For this business, let us assume that two types of fixed assets will be needed: furniture and fittings and computers. So I'll start with modeling of furniture and fittings by double tap to open the type pad, and then write furniture and fittings, furniture and fittings. Which will start with the cost component, cost, which will have opening balance, and then addition of assets of furniture and fittings in this case, and then there will be disposals, for furniture and fittings, and then we'll have closing balance. Closing balance. So that is the structure of cost component, and let me program it. Let me double tap on column A header to expand the column so that it fits the particulars. So I double tap. I'm done. Now let's put the additions first. Let's start with the additions. For this business assumptions, we said that we will rent for the office in March. Okay, there is where the office is rented and started to be used. So it is this time where we will purchase furniture and fittings for the shop. So I click on March in the additions section there, and let's say the furnitures and fittings will cost 3 million Tanzanian shillings. So I type 3 million, and so let me structure the closing balance. Will be opening balance for the cost plus additions minus disposal. That's what you get. You get closing balance. The disposal, I will add them as minus. So my closing balance will be the summation of opening balance plus additions minus disposal. So I just put the summation. Let me put opening balance 0 here, 0, so that when I put a formula on the closing balance, I sum here, it will pick directly. So check on the green button to the top right. So I have the formula for closing balance, and tap to fill it to the rest of the projection horizon. Okay, so we are filling the closing formula for furniture and fittings, and on the opening balance for February, will be closing balance for January. So I put I double tap to open the formula here, start with equal to, and pick closing balance for January and enter as opening balance for February, and tap to fill this because it is true throughout. Okay, after doing that, then this is the cost component. We have the depreciation component. Let me bold these two items here, bold, and then let me now type depreciation component of furniture and fittings, and I also bold this depreciation, and I can copy now. I can copy all this, and including their formulas here, they are also true for establishing closing balance. So I'm copying all of this up to here, copy, and then go back at the beginning and paste them here at the depreciation area, paste, So what I'm doing now is changing on the additions here. I remove this 300 because we are not in the addition of assets here, we are in the depreciation section. So I remove, okay, instead of removing, let me just come here at the beginning and put formula for addition of depreciation. So depreciation for furniture and fittings is normally 12.5% per annum. Okay, so I'll start with equal sign, pick closing balance for furnitures here, multiply by 12.5%, that is per annum. So to get per month, because we are modeling on monthly basis, I divide it by 12. Okay, so press enter, and now I can just tap to fill this to the rest of additions row of depreciation. That's how depreciation is added. And after that, then what I have is net book value. What I have now is net book value of fixtures and fittings. That is, put a formula here, is a function of closing balance of cost minus closing balance of depreciation. Okay, so that is the net book value for furniture and fitting. And then I tap to fill, because it is true, this formula is true throughout our projection horizon up to there. And after that, let me first, I don't see the rows for year and month, so let me go up and freeze the pane at this location so that I can see the rows for year and month, and at the same time I can see the column for particulars. So I go to view and then freeze pane to freeze the pane. So I'm done. Okay, so now we are done with the modeling for furniture and fittings. Because the structure will also be the same for modeling computers, so what I do is simply selecting all these up to net book value here, and then drag this to the end. I select particulars and all the formulas that have been modeled on functions and fittings, and then after that choose copy here on the local menu and come down here and then paste, tap to paste. So I have pasted it, and now I can just edit. Instead of furnitures and fittings, now it is computers. So I go back to this typing pad and type computers. So we have cost element. For additions, let us assume that this guy, shop manager, the computer will be for shop manager, and shop manager starts engagement on January for setup. Okay, so let us assume that the computer, we will buy it for shop manager on January. So let me clear this figure, which was for furnitures and equipment, first by tap to clear, and put additions at January. Say the laptop for the shop manager is 2 million. 1 2 3 4 5 6 2 million Tanzanian shillings. Okay, and so we have modeled the computer's cost part, and because the rest were the formulas, so when we paste them, the same formulas have applied, so we don't have to do anything else there. And we go to depreciation component, and we change the formula for depreciation here, because what it is right now, it is 12.5%, which was for furniture and equipment. So we change it to put the depreciation rate for computers, and this is normally is 33.33%. Okay, so we change that, check to accept, tap to fill, so that this formula is applicable throughout the projection period for computers, depreciation for computers. So we are also done with modeling for computers, because the rest of the cells have formulas, so automatically the Excel generated the output for those after putting additions, and after putting additions on both cost and depreciation. So let me first format this one, so that we have accounting format up to here. We have accounting format for numbers, and for credit numbers we should have red. So I'm going to home menu, click on this 1 2 3 icon, click comma to put commas, and I remove these two decimal places by clicking twice here, and then I go to number, and I choose this negative numbers second format, which should be red. Okay, so after doing that, let me now put the summaries that are going to be reflected in our financials. So the first one, it is the additions component. This one draws out cash out of the business. When you add furniture, when you add an asset, it draws out cash because you have bought it. So I'll put additions. Let me tap here, double tap to put additions. And this addition, we can simply pick them. We don't need the summary because we are going to add them one at a time. So the next one is depreciation. This is the one that will just need one figure. So let's have the summary for depreciation. Depreciation. This one is going to profit and loss as expense. So we have depreciation for furniture and fittings. Furniture and fittings. And we have depreciation for computers. So we are going to pick them. Furniture and fittings, the depreciation addition is on B11, okay, for January. So enter. And for computers, it is the addition for depreciation is on B24 for January. Here, enter. So we have those, and I use sum to sum the two, enter, and in order to get total now, total depreciation, total, okay, let's just say total is enough for depreciation. And then I select this because we all have formulas here. I select to fill to the rest of our projected horizon, because those formula are going to be applicable throughout the projection period. So we are done with modeling for depreciation total, and in balance sheet we are also going to have a total figure for net book value. So let us make a summary for them. NBV, net book value, we have for furniture and fittings. We have computers. So let's go pick the figures for January. Start with equal sign. Net book value for furniture is this one, enter, and for computer is this one, net book value here, enter, and then I just use sum to add them twice, and this is total, and I can select this, fill to drag them throughout the projection period. Okay, now after that, let us now, so our components that are needed to be input into our financials about fixed assets are already arranged. So what we are now going to do is to go to P&L, and then let me insert a row above bad debts, insert row, and then double type to write depreciation. Depreciation is an expense, so it is booked in profit and loss on the administrative expense section. So on the January there, I click equal sign, start with the equal sign and go click on assets sheet to pick the figure for total depreciations in January, which is here. Depreciation here, oh sorry, here, not there, here, yeah, that is the total depreciation. So I enter, and this formula is going to be true throughout, so I tap to fill, oh sorry, tap to fill throughout our projected periods. So this is the first component for double entry transactions for fixed asset. The depreciations are debited or are accounted on administrative expenses on profit and loss. The next is on cash. Now on our structure we are going to add particulars for furniture and computers on cash flow from investing activities. Okay, so because these are investing activities, fixed capital expenditure. So I click here and type furniture and fittings, double tap to open the type pad, furniture and fittings, and then computers. So furniture and fittings, cash. When in the asset side, let me start by equal sign, go to assets, and we go to furniture and fittings on the additions row. When we add an asset, we draws out cash from the business. So this, to instead of just picking the figure for asset additions here, I should start with minus sign first. So equal sign and then minus, and then pick the addition column for January here, furniture and fittings here. So that is where we are going to pick it in our cash flow statement. And for computers the same, start with equal sign and then minus, and then go to asset sheet and then go to computers here, additions for January, which is here, and then press enter. And after that, total cash flow from investing activities, just put sum them, and all these formulas here, the three formulas, are going to be true. So I select them and then fill to drag them to the rest of projection periods. Okay, so this is the second component of our accounting for fixed assets. The first one was depreciation, which was the expense in profit and loss at administrative. The second is the additions of fixed assets that draws out cash. So we have withdrawn cash. You see the negative number. we have withdrawn cash to buy those assets. And the last one is the net book value now in the balance sheet. So we go to balance sheet. As you can see, the check for balance sheet is not balancing. The check is not balancing. So let us add fixed asset here, and let us double tap to write NBV, net book value, and put equal sign, go to assets and pick the total for NBV, which we have done the summary, and we are here at January, so this one in the total, enter, and then I tap to fill this throughout the projection period because it is applicable. The formula is applicable on each month. So after doing that, my balance sheet should balance. As you can see, the check down here is 000. So my balance sheet has balanced. But let us go to the assets and explain a thing here. For furniture and fitting, during this projection period of 3 years, because we have a depreciation rate of 12.5%, so the furnitures and fittings have not been fully depreciated yet by the end of our projection period. Okay, we still have net book value, which is positive. But for computers, because the rate is 33.3% is big, so we have net book value which is negative. You can see the negative net book value started in January year 3. Okay, there is where the computer is fully depreciated. Okay, now the assumption here now is that when an asset is fully depreciated, we dispose it. Okay, we dispose it out of the business, and the assumption here is that we are going to dispose it at its cost value. We assume that it is fully depreciated, so we are going to dispose it at its cost value. We don't consider any gain or loss on disposal. No, we simply assume what we have purchased, and when the asset is fully depreciated, we dispose it at its cost value. Okay, that is the assumption we are going to do for modeling of disposal. So you can see net book value on December 24th is just 200 here. So we need to, when the net book value starts to be negative in January here, we need to do our disposal. So the disposal here, we are going to dispose the old figure, the old computer. So I double tap to start with equal sign, and then put minus, because disposals are in this model are reported as negative figure, and then click on the cost element here. I can just click the cost element here and then enter. So we remove it out of the asset, out of the computer's schedule, fixed asset schedule for computer or for fixed assets account, we remove it, so we dispose. And when you dispose, you also need to dispose all accumulated depreciation and net book value that have left for that. So on the cost side, we have already disposed it, is the cost of value, and on the depreciation side here we're also going to dispose it. So I start with an equal sign and then minus. First, as I said, all this closing balance on depreciation, accumulated depreciation, we dispose it, and also I put another minus here and then click on net book value that has remained. It is also going to be disposed. That means we are shifting them to disposal account for the purpose of disposing this asset. So I click enter. So after doing that, you can see my closing balance now becomes 0 because we have disposed this asset. And here net book value is 200. Why? Let me see. Disposals, that was 200. Let me see in the balance sheet first if my balance sheet has balanced. So let me go to balance sheet. Yeah, it has balanced after doing those adjustments. So basically what we did in the asset schedule here, we disposed the cost element, and we also disposed the depreciation element fully by the cost figure, that is 2 million. Okay, so we are done with the modeling for, but at the same time we need to opening balance. No, this is not normal. Why do we have opening balance, closing balance, net book value, closing balance? How do we get this closing balance here? Let me see. Okay, yeah. So in addition section here, as a procedure for disposal of an asset, we also need to the remaining book value, this one net book value, that is 200, the remaining book value of the asset that is going to be disposed is also need to be added as depreciation for that period when you dispose it. So even the net book value of that asset that is going to be disposed is also removed and transferred to disposal. So here on this specific month, I will add the, on top of the normal depreciation, I will add, let me choose this. So I will plus this component of net book value that has been remaining, enter. Okay, what has it done? Additions. Okay, so it's okay. So the depreciation, the closing balance here, because we have disposed, the closing balance is 0, so the depreciation is 0. But because we have added the remaining net book value of the asset that is going to be disposed, so the total that is going to addition of depreciation for this month of January 25 for this process of disposing the asset is the remaining net book value, which is 200. So we are done, and now you can see after this we have net book value of 0 and closing balance of 0 throughout the projected horizon, which is now correct way of accounting for disposal. And if I go to balance sheet, let me see my balance sheet for the check here. It is balanced throughout. So we are done. But let us come back again here. We have disposed the old computer, that is 2 million. Now we need to buy a new one for the shop manager because we are disposing the old one. So in the addition section here, I click on January 25 there where we made a disposal. I add a new laptop. Let's say now it is 3 million instead of 2 million we purchased earlier. So I double tap and then put 3 million Tanzanian shillings. So we have added that additions, and after adding, definitely the rest of the formulas now apply and depreciation has started to be computed. Now in the net book value we do not have the negative number anymore. Okay, after disposal and after adding the new fixed asset, then our accounts are okay, and even in the balance sheet should be okay now. It's okay till the end, because the additions that I have done, also there are formulas that picks it to go to cash flow as draw out of cash, that picks its depreciation to go to P&L and its net book value to go to balance sheet. So whatever I do additions here, the formula automatically computes and send the right transaction to the right place. So that is the modeling for fixed assets, and we should end up here for this presentation. Welcome back to forward presentation so that you get quality knowledge on financial modeling. And as I said, this is the methodology that I have developed myself, so it's unique and you are not going to see such a similar modeling, but definitely this is the best one. I think if you have followed my tutorials up to now, you should see it that this is the easiest and funniest way of doing financial modeling. So subscribe to my channel so that you get posted whenever I share new tutorial videos. The journey is still there. We need to introduce capital, we need to introduce loan for financing and other stuff. So bye for now, see you later.